Hello everyone, welcome to my channel hdorionn. We are studying accountancy for class 12th from T.S. Grewal's textbook 2023 edition, Accounting for Partnership Firms. Chapter 4, Admission of a Partner. And in this video, we will study questions related to preparation of revaluation account, partners' capital accounts, and balance sheet of the new firm. So let us see some questions from the textbook. I believe that you have watched all the previous videos so that in every other video we are growing with the concept and new things are discussed. New logics and new treatments of certain things are discussed in every question. So please don't skip the previous videos. Watch the entire video and listen to the explanation to be benefited. Now let us see question number 73. Sunaina and Tamanna are partners in a firm sharing profits and losses in the ratio of 3:2. Their balance sheet as at 31st March 2020 stood as follows. Now reading and comprehending the question is very important, and one should retain the information given in the question till you solve the question. Otherwise you will again see the question, which is a wastage of time. So I'm not saying that you should not come back to the question, means you should not look the question again. One can see that, one can come back and see what is written in the question. But if you remember the things precisely, then your solution will be, you will be doing your solution in less time. Fine, and your memory skills will also improve. So for that reason, I suggest that one should remember what are the details of the question and use those in the solution. To the liabilities side, we have got capitals Sunaina rupees 60,000 and Tamanna rupees 80,000, and current account is also there, Sunaina rupees 10,000 and Tamanna rupees 30,000. It means the capital account is fixed, and all the adjustments related to revaluation and admission of revaluation and treatment of goodwill, transfer of reserves, all these things will take place in current account, not in capital account. There is a general reserve of rupees 1,20,000, workmen compensation reserve of rupees 50,000, creditors rupees 1,50,000. To the asset side, we have got plant and machinery rupees 1,20,000, land and building rupees 1,40,000, debtors of rupees 1,90,000 less provision for bad and doubtful debts rupees 40,000. In the outer column it is 1,50,000. Stock rupees 40,000, cash rupees 30,000, and goodwill rupees 20,000. This is the existing goodwill or purchased goodwill purchased, and therefore we will write it off in old ratio. Furthermore, the question says they agreed to admit Pranav into partnership for 1/5 share of profits on 1st of April 2020. On the following terms, all debtors are good. It means this provision is not required. You see, in the balance sheet there is a provision of rupees 40,000 for bad and doubtful debts. When all the debtors are considered good, this provision is not required. So that leads to decrease in liability because provision is a liability. Value of land and building to be increased to rupees 1,80,000. Value of plant and machinery to be reduced by rupees 20,000. Now these prepositions one should care for. To rupees 1,80,000 and by rupees 20,000 has different meaning. The liability against workmen's compensation fund is determined at rupees 20,000, which is to be paid later in the year. So there is workman compensation of 50,000. Out of this 50,000, 20,000 rupees will be retained for the future to compensate a workman. Fine. Anil, to whom rupees 40,000 were payable, already included in above creditors, drew a bill of exchange for 3 months, which was duly accepted. So here creditors are converted into bills payable. Fine. There is a creditor whose name is Anil. He is we have accepted a bill of rupees 3 months. So creditors will be converted into another liability, which is bills payable. Pranav to bring in capital rupees 1 lakh and rupees 10,000 as premium for goodwill in cash. journalized. So we just have to pass the journal entry for this. Solution 72. First, we will pass journal entries related to revaluation account, and revaluation account debited. First, let us start with, it is all on 1st of April 2020, because this is the date on which a new partner is admitted. Revaluation account debited. So when is revaluation account debited? When there is decrease in asset or increase in liability. So when you see the question, in that, it is not 72, it is question number 73. In point C, it is written value of plant and machinery to be reduced. So to plant and machinery, it is reducing by 20,000. And that is the only thing. No liability is increasing, neither any other asset is decreasing. Being decrease in the value of asset. Now something, when revaluation account is to be credited. Revaluation account is credited when there is increase in asset or decrease in liabilities. So point A, all debtors are good, so it's a decrease in liability, so provision is not required. Provision for bad and doubtful debts. Provision for doubtful debts. This is of rupees how much? 40,000, because a liability is decreased when it is debited. And second is land and building is also land and building. I will write in full. Land and building. The value is also increasing by rupees 40,000. From 1,40,000 it has increased to 1,80,000. That is all to revaluation account. So it is a case of increase in asset or decrease in liability, rupees 80,000. Being decrease in liability and increase in asset, in the value of asset. Now revaluation account is debited with rupees 20,000 and is credited with rupees 80,000. So difference is 60,000, and that is giving us a credit balance of rupees 60,000, which is a profit on revaluation. So that entry we will pass. Revaluation account will be debited with the credit balance. You see, on the credit side it is 80,000, on the debit side it is 20,000. So 60,000 more we will debit revaluation account with, so that the amount is equal 80,000, and here also 80,000. So it is a credit balance and it is profit, and it will be transferred to old partner's current account, Sunaina's current account. Why? Because capital account is fixed. You can see in the balance sheet current account is mentioned, and Tamanna. In their profit sharing ratio, that is 3:2, so 36,000 and 24,000. Being profit transferred in old ratio, that is 3:2. Now when you see the balance sheet, to the liability side there is general reserve and also workmen compensation reserve. These are undistributed profits of previous year, which will be transferred to partners current account in their old profit sharing ratio. So let us do with general reserve. General reserve is a liability. It is closed by debiting it, and the amount is rupees 1,20,000, transferred to Sunaina and Tamanna. in their old profit sharing ratio, that is 3:2. Being general reserve transferred to old partners in old ratio, which is 3:2. Also, there is workman compensation reserve. So this reserve will be transferred to old partners. So workman compensation reserve account debited, but there is a the firm has decided to uh, keep 20,000 rupees for future out of this workman compensation reserve. So we will out of rupees 50,000, 20,000 will be kept with the firm and remaining 30,000 will be paid to the partners. So there is, it is determined. So workman compensation reserve claim, because it is determined, fine. So in future this 20,000 rupees will be paid to some claim and remaining 30,000 will be given to Sunaina and Tamanna. In their old profit sharing ratio, that is 3:2, being workman compensation reserve transferred. Now in the balance sheet there is old existing goodwill on the asset side. So goodwill given in the balance sheet is debit balance, so it will be credited and partners current account will be debited. So Sunaina's current account debited and Tamanna to old existing goodwill. Goodwill is never to be shown in the books of accounts in their old ratio. So it will be how much divided by 5, 12,000 and 8,000. Being existing goodwill written off in old ratio, that is 3:2. Now we will pass the journal entries related to admission of new partner Pranav. For that, bank or cash account will be debited to Pranav's capital account. Don't write current account because it is a part of capital which the partner is bringing. So it will be capital account, not current account. To premium for goodwill. Premium for goodwill. That is the amount of compensation to the old partners or to the sacrificing partners which Pranav has brought. In the point F, it is mentioned that premium is rupees 10,000 and capital brought in by him is rupees 1 lakh. So total 1,10,000 is received by the firm. Being capital plus premium brought by Pranav. Now this premium is the compensation which Pranav has brought for the sacrificing partners, because old partners have sacrificed their portion of profit in favor of new partner Pranav. So this premium will be paid to the sacrificers. Premium for goodwill account will be debited and closed. Rupees 10,000 and transferred to the current account of sacrificing partners, that is Sunaina and Tamanna. And their sacrificing ratio is also 3:2. So 10,000 broken in 3:2 is 6,000 rupees and 4,000 rupees. Being goodwill or premium two old partners in sacrificing ratio, which is 3:2. Now we know that the new partner will get 1/5 in the total profit of the firm, and this 1/5 will be contributed by old partners in their old profit sharing ratio. That is the meaning of this, because new ratio is not given in the question, nor a special sacrificing ratio is given. Therefore, the sacrificing ratio will be the old ratio of the partners. There are so many details and concepts related to the topic which cannot be discussed in each and every video. Therefore, you have to go through all the previous videos in order to get a good understanding on the topic. If I start giving each and every concept in every video, then it will be too lengthy and too boring. You will not enjoy the video, and therefore it's in every other question a different thing is discussed. In every question, I even try to remind you of what I have taught you in previous videos. Related topics means those repeated concepts are also reminded by me in every video, but each and every detail is not possible. One should understand this, and therefore watching of previous videos will be very, very beneficial for you, because in the comment section sometimes I find that you want more explanation on the topic, but I will say to that we have already discussed it, and whenever I feel like, I do discuss that in short in videos. Now let us see question number 74. Following is the balance sheet of Jay and Viru as at 31st March 2023, who are partners in a firm sharing profits and losses in the ratio of 3:2 respectively. To the liabilities side, we have got creditors of rupees 45,000, general reserve rupees 36,000, capital of A rupees 1,80,000, Viru rupees 90,000, current accounts of Jay rupees 30,000 and Viru rupees 6,000. To the asset side, we have got cash at bank rupees 15,000, debtors rupees 60,000 less provision for bad and doubtful debts rupees 2,400. In the outer column, there is 57,600. Patents of rupees 44,400, investments of rupees 24,000, fixed assets of rupees 2,16,000, and goodwill of rupees 30,000. So here this goodwill is the old existing goodwill, and it is to be written off from the books. So is general reserve, and grand total is 3,87,000 on both sides. Sri is admitted as a new partner on 1st April 2023 on the following terms. Provision for doubtful debts is to be maintained at 5% on debtors. Outstanding rent payable was rupees 15,000, and accrued income of rupees 4,500 does not appear in the books of the firm. It is now to be recorded. Jay takes over the investment at an agreed value of rupees 18,000. New profit sharing ratio of partners will be 4:3:2. Sri will bring in rupees 60,000 as his capital by check. Sri is to pay an amount equal to his share in firm's goodwill, valued at twice the average profit of the last 3 years ended 31st March 2023, 2022 and 2021, which were rupees 90,000, rupees 78,000 and rupees 75,000 respectively. Half of the amount of goodwill is to be withdrawn by Jay and Viru. You are required to pass journal entries, prepare revaluation account, partners capital account and current accounts, and the balance sheet of the new firm. Now, what is special in this question? Not so special. These things means here the new ratio is given, which is not the same for the old partners. As a result, we will calculate sacrificing ratio for treatment of goodwill. And here is the method or way how goodwill is to be calculated is given in the question. Fine. So let us pass the journal entries also, revaluation, capital account and current account. You see, such type of questions are for more than 8 marks. In your board exam, you get a maximum mark maximum 6 mark question, but this question can be of more than 6 marks because the journal entries are also asked. At the same time, revaluation account is also there, partners capital account is also there, current account is there, and balance sheet is there. So it is such type of questions are equivalent to 3-4 questions. So if you get the understanding of such complicated big questions, then believe me that you have you have the potential, or you have understood the concept of 3-4 questions, different questions. See, either the same question you may have only to prepare revaluation account, or only to pass journal entries, or only to prepare revaluation account and partners capital account. So like that. And for the previous years, we have seen that balance sheet is also not asked in the board exam, but we are getting a good comprehensive view of the topic. So let us see the solution for this. Solution 74. First, we will pass journal entries related to revaluation of assets. So all the journal entries are on 1st of April 2023. Revaluation account debited. It is debited when there is decrease in asset or increase in liabilities. So as per the question, the provision for bad and doubtful debts are increasing. So to provision for doubtful debts. Now here 60,000 is the debtor and 5% we have to maintain. 60,000's 5% is rupees 3,000, but there is already existing provision of rupees 2,400. So increase in provision for doubtful debts is only for rupees 600. Fine. Then outstanding rent. A new liability of rupees 15,000 is there. Then investments are decreasing. See, one of the partner has agreed to take investments at a lesser price. So how much less it is? So to investment, 24,000 worth investments are taken only for 18,000. So there is a decrease of rupees 6,000 in the asset. So assets are decreasing. So when we add here, it is 21,600. Being assets increased and liabilities decreased. Now there are 3 different accounts credited. You can pass 3 different journal entries for this, no problem, but that will be time consuming. So in one single journal entry also you can make a compound entry. Fine. Now let us talk on when revaluation account will be credited. Revaluation account is credited when assets are increasing or liabilities are decreasing. So here there is one asset, that is accrued income, we have to add to the balance sheet. So accrued income is an asset. It is debited and increased rupees 4,500, and to revaluation account rupees 4,500, being increase in asset. Being increase in assets. Now you see revaluation account is debited with rupees 21,600 and it is credited only with rupees 4,500. So the difference is how much? Difference is 17,100. So we will credit the revaluation account with the difference in amount, and this is a debit balance, and so it is a loss on revaluation. So it will be transferred to partners capital account. So Jay's current account, because capital accounts are fixed and therefore all the treatments will be made through current account to revaluation account. 21,600 in the debit and 4,500 in the credit. It is giving us a debit balance of rupees 17,100. When broken in their old ratio 3:2, it is 10,260 and rupees 6,840, being loss on revaluation. Writing of narration is a must. Do not skip narration because a journal entry is incomplete without narration. What transaction you have passed, that is to be reflected in your narration. It can be in your words, simple words, but narration one has to write. And now let us see the balance sheet. In the balance sheet, there is old existing goodwill which we will write off. So again, capital account, current accounts of old partners will be debited. JS current account for writing off old existing goodwill to goodwill. Goodwill is an asset and now it is credited and closed. This goodwill is of rupees 30,000 and old ratio is 3:2, so 18,000 and 12,000. Being old goodwill written off in old ratio, which is 3:2. Now there is general reserve also. So general reserve is a liability. General reserve is a liability. It will be debited and closed. And the amount is rupees 36,000 transferred to old partners. Jay's current account and to Viru's current account in their old profit sharing ratio. 21,600 and 14,400 being general reserve transferred. Now, as per point D, J takes over investments at an agreed value of rupees 18,000. So, J's current account. J's current account will be debited because J is taking the investments 18,000. Being investments taken over by partner J. Now let us calculate goodwill of the new firm. So goodwill of the new firm, the question says 3 years average profit, and 3 years profits are rupees 90,000, rupees 78,000 and rupees 75,000. So average means divided by 3, and then we have to multiply it by 2. So this amount will give us rupees 1,62,000 as firm's goodwill. Now new partner Sri's goodwill is equal to 1,62,000 into his portion, that is 2 by 9, which is equal to rupees 36,000. Now sacrificing ratio, because old ratio and new ratios are not the same for the old partners, let us calculate sacrificing ratio for old partners. Now let us calculate sacrificing and gaining ratio. So there are two partners, J and Viru. J is to Viru is equal to 3:2, and J is to Viru is to Sri is equal to 4:3:2. So here we see that the ratio of old partners are not the same, and therefore we will calculate sacrificing ratio, which is equal to old ratio minus new ratio. For J is equal to old ratio 3 by 5 minus new ratio 4 by 9. LCM is 45. 9 3s are 27 minus 20, that is equal to 7 by 45. And for Viru, Old ratio is 2/5 minus new ratio is 3/9. LCM is 45. 18 minus 15, that is equal to 3/45. Because the denominators are same, therefore the numerators are the sacrificing ratio, that is 7:3. So treatment of goodwill, this goodwill, Sri's goodwill will take place in this ratio. So when you break this in sacrificing ratio, J will get an amount of rupees 25,200 and Viru will get an amount of rupees 7,800. So now let us pass the journal entry for admission of new partner Sri. For that, bank account will be debited. Bank account debited to Sri's capital account and to premium for goodwill. So goodwill brought is 36,000 and capital brought by new partner is 60,000. So a total of 96,000 is brought by new partner. Being capital plus premium brought by Sri. Now we will distribute this premium. So premium account debited, premium for goodwill to J current account because capital account is fixed, and to Viru current account. 36,000 broken in sacrificing ratio. Sacrificing ratio is 7:3. It is 25,200 and rupees 10,800. Being goodwill to old partners in sacrificing ratio, that is 7:3. Now it is asked in the question that half the amount of goodwill received by old partners have been withdrawn by them. So Jay and Viru will withdraw. So when they have received it in current account, they will withdraw also in current account to bank. So 36,000 they have received as premium for goodwill and half they will withdraw. So the amount they have withdrawn is rupees 12,600 and rupees 5,400. Total is 18,000 withdrawn. Being 50% of goodwill withdrawn. So these were the journal entries related to the question. Now we will prepare ledgers. So in revaluation account, we will record all decrease in asset or increase in liabilities to the debit side and increase in asset or decrease in liability to the credit side. And we know that provision for bad debts, provision for doubtful debts. There is a provision of rupees 3,000 to be made and available provision in the balance sheet is 2,400. So increase in liability of only rupees 600. Then there is outstanding rent of rupees 15,000 to be created and investments are going down by rupees 6,000. Only this much on the debit side. Grand total here is 21,600. Accrued income is increasing. It is a income. It is a asset. We have to record it in the books of rupees 4,500. Now there is a debit balance of rupees 17,100, which is a loss. So by loss on revaluation, it will be paid to old partners J and Vijay. J and Viru in their profit sharing ratio, which is 3:2. So breaking this amount in this ratio, we already know this, we have calculated during journal entries, 6,840. Now let us prepare partner's capital account. It is fixed in nature because current account balances are given in the question. So we will write the opening balances for the old partners, that is balance brought down, and for capital it is 1,80,000 and rupees 90,000. Now new partner Sri is bringing by bank an amount of rupees 60,000 as his capital. That much only we have to record here, and all the other transactions to the partners will be shown in partners current account. Here the capital account is fixed and therefore we have to close it. No other transaction will be shown here. In fixed capital account, only the drawings from the capital is shown, and in this question there is no drawings made as such. Now let us prepare partners current account. First we will write by balance brought down. It is 30,000 and rupees 6,000. Current account for the new partner will not be prepared because there is no transaction in this. In Shree's current account, there is no point making Shree's current account. Only old partners or previous partners current account will be prepared because much transactions are here. So by general reserve, from the balance sheet it is transferred in old profit sharing ratio to them. Then goodwill, old goodwill will be written off in old ratio. So 30,000 in 3:2 is 18,000 and 12,000. Loss on revaluation, it is 10,260 and rupees 6,840. Then investments are taken by Jay at rupees 18,000. So two investments, Jay took this, so we will record it in Jay's column. And then premium for goodwill, which is brought by new partner Sri in sacrificing ratio. So 36,000 broken in sacrificing ratio, this much. But whatever goodwill they received, half the goodwill is withdrawn by them. It is stated in the question. So it will be withdrawn from the debit side bank. Half of this amount is rupees 12,600 and half of 10,800 is rupees 5,400. This much transaction. Now we will close it. So we will get a credit balance here. To balance close down, grand total here is 76,800 minus all these figures will give us rupees 17,940. And for Viru, grand total is 31,200. When you subtract these three items from this, you get rupees 6,960. So with these closing credit balances, we will prepare the balance sheet of the new firm. In the balance sheet, let us write the capital account balances first. Capital account balances of partner J is rupees 1,80,000. Viru rupees 90,000 and Sri rupees 60,000. Total is rupees 3,30,000. We also have current account balances, credit balances of J and Viru of rupees 17,940 and 6,960. Add this, and in the outer column 24,900. Then from the old balance sheet there is creditors unchanged. No change in the value of creditors, 45,000. Then newly created liability is outstanding rent of rupees 15,000. That much only on the liability side. To the asset side, we have got bank. There was already 15,000 in the beginning, plus 60,000 is the capital brought by new partner Sri, and 36,000 premium for goodwill brought. Out of this 36,000, half the premium is withdrawn, so we will subtract here, and the remaining bank balance is 93,000 rupees. Then come to debtors. Debtors are for rupees 60,000, and provision for bad debts we have created 5% of 60,000, that is 3,000. So in the outer column we will mention 57,000. Though provision for bad debts is a liability, so instead of showing it on the liability side, we can show it on the asset side by subtracting it with the debtor, as we all know. Patents. Patents are unchanged in value, so 44,400. Then fixed assets, unchanged value, it is 2,16,000 rupees. Then our new asset, accrued income is to be added, so that is of rupees 4,500. That much only on the asset side. Now we will grand total it. So when you add here, you get rupees 4,14,900, and here also same. So the total is agreeing. So this way the balance sheet of the new firm is prepared. I hope that you have watched the full video and have listened to the explanation properly. If you find the video interesting and informative, please like it and share it with your friends. Thank you so much for liking, subscribing and sharing this channel. Thank you so much for watching this video.